Okay, with this part two of our lecture for stocks, we're going to look at how companies actually pay their owners in the form of dividends. We're going to look at what steps that it takes to issue a dividend, and then the difference between a cash dividend and a stock dividend. And then the last piece, we'll briefly look at how does a stock split, what is a stock split, and then how does that affect the company and an individual owner's stock as well. All right, first thing here with dividends, dividends are declared by, remember, the board of directors. The board of directors will look at the company's financials and decide and see how much money they are earning. Typically, they'll look at their net income, how much money do they have available to spend, how much cash do they have ready to spend or to give out as well, and then they'll set a declaration. And I'll skip down here. The three steps into the dividends, the first thing the board decides and they have a declaration date, that's when it actually becomes a liability. The company has to pay it at that point. Otherwise, remember, the company doesn't pay dividends unless the board makes it a mandate here and declares it. Then the board will say, we're going to pay our dividend. It's now July 1. We're going to pay it the first week of August. And we're going to pay it to whoever owns stock, and then they're going to set a date. Whoever owns stock on this date, either maybe today or a month ago or a month, 2 days ahead of a frame, that's who's going to get the dividend. Typically, your dividends, the board is going to look, as I said, at net income. That's where the money should come from, out of your excess profits. But again, companies do not have to give out all of their net income. They don't have to give out any of it if they don't want to. Small companies and those who are trying to grow and grow, a lot of times will forego giving out dividends. And the owners will typically know this, knowing that they're going to reinvest all of their profits to buying new machines, more equipment, hire more personnel. They're going to keep that money instead of giving it out as owners and then kind of the company staying flat. They're going to use that money to grow. With a stock dividend, some companies may want to continue to issue dividends because they have a reputation to issue dividends, but they may be short on cash at a certain point of the year. And then what they could do is offer a stock dividend. And a stock dividend is simply giving your current stockholders, instead of giving them cash, offering them more pieces of stock. And then the good part for the stockholder is they could then turn around and sell that stock and then get whatever the market price is. So it's kind of like getting cash. It's just depending on what you want to do with it. A lot of companies will do this for their employees. There'll be a stock incentive program, whereas if you perform so well, you'll get shares of the company stock. And that's what they're doing here. Very similar. I wanted to show you kind of what that looks like as a journal entry. If we declare a $1,000 dividend, stock dividend, and the stock is a $1 par, and it's currently selling for $3 each, well, the total amount of dividend technically that I'm giving out is $3 a piece times 1,000 shares. So $3,000 in dividends. And then how I would, the rest of the journal entry would be crediting my capital stock, because I'm actually giving up stock, I'm actually issuing stock, $1 a piece at the par rate, $1 times 1,000 shares, and then the rest to equal my debits here is my additional paid-in capital for the common stock. The last thing that well, it's not quite the last thing, it's the last area here, is a lot of owners, before they buy stock, this is a very common ratio that you really should know, and you will hit this in other courses as well. It's called your earnings per share. EPS is for short. And a lot of companies, you'll see this if you look on a company's financial page. They list their earnings per share. what this does is it tells owners in a best case scenario, and it makes it an even playing field at that point as well, because companies don't have to give out dividends and you can still figure up their earnings per share. Even if they don't give out a dime, I can still compare every company and assume best case scenario. How is the company doing versus how many stocks they have issued? So it's the best case scenario, and how much would I get as a dividend stockholder, or as a common stockholder, if all of the net income, all of the earnings were distributed to the owners? Do I have a reasonable chance of doing well? And that all depends on A, how good the company's doing, how well the company's doing, and B, how many shares are out there. If there's a quadrillion number of shares, if the company even makes $1 million, I may only get pennies as a dividend. Whereas if there was only 100 shares outstanding, I'm going to reap the benefits there because there's not very many people to spread around the wealth. So the real simple equation to get your earnings per share is to say, okay, if all of the net income is distributed, and then I need to remember, well, I got to subtract out the amount that goes to preferred stockholders because they always get first dibs. I'm never going to get those preferred stockholder dividends, so I got to take that out of the equation because this is, again, best case, not unrealistic case. So best case, net income minus what the preferred stockholders are going to get, and then dividing by, well, how many shares are actually outstanding of common stock? Is there a quadrillion or only 150 shares outstanding? It's going to make a big difference in how much I get on a per share basis. Best case scenario. The other equation to look at is, what am I actually going to be getting? This was best case, where I can compare all companies. This is what I'm actually getting with an individual company. And it's even a little easier to calculate. All you do is look at, well, how much did they give? How much did the company give in dividends to common stockholders? Divided by how many common stockholder shares are outstanding. What was the actual amount given to my common stockholders? Was it $3 a share or $10 a share? All right, let's look at an example now. And the last thing to hit here is a stock split. A stock split is simply taking say a $100 stock and then splitting it in half. So now instead of one $100 stock, you now have two $50 stocks. And what happens then is, so the price per share usually gets cut in half, and the par value gets cut in half as well when you have a 2-for-1. So if I have a $100 stock, you now have, if you have 100 shares, you now have 200 shares, but they're worth half as much. So nothing really, the key thing that I want you to get out of stock split, there is no journal entry, and in no way does it affect our books, because it's still the same. It's the same if I have two $50 shares or one $100 shares. I have the same value. The main reason that companies do a stock split is that more investors will be brought in with a lower and lower price. Not very many people can jump into the market if your stock's valued at $130 a piece, but you'll have a lot more people coming in if it's only $25 a piece. So that's the main reason companies do a stock split, and it generally helps the price of the stock go up, so therefore making your owners happy. All right, let's finish up our example on number 46. We're down to the last two dates here where we're actually issuing dividends, and then we're going to close out. We're going to close out our net income and our dividends. We're going to do a closing entry, and then look at how everything ends up taking our T accounts and putting them into the balance sheet as part of the stockholders' equity. So the first thing is here, let's look at how we issue a cash dividend of $150. Notice that it is declared Board has declared it, so therefore it's a liability at this point because I'm not paying it until the first part of next year. And when I put that it's a liability, I want us to actually specify who gets what. Who gets what out of this $150? How much goes to common and how much goes to my preferred stockholders? So that's, well, we can go ahead and do the debit part of this question. The debit part is the easy one. I go ahead and tell you how much of a dividend we are offering. $150, that's our debit. Now the credit we're going to break into two pieces, two liability accounts, the dividends payable for preferred stock and dividends payable for common stock. Now let's go back and look at how we figure the dividends for the preferred stock. Remember back up in December 5th, I issued 10 shares of 10% $50 preferred stock. The first thing I need to do is combine these two. 10% of the 50 says for every share of preferred stock, I'm going to give them $5 of dividend. And then the only other thing I need to decide is how many shares are out there. If I give $5 per share, there are 10 shares currently out. So 10 times $5 a share, my preferred stockholders are going to get the first $50. The rest will go to my common stockholders. Dividend, this DP stands for dividends payable, just like an account payable. But remember, account payable is like if you're paying company. Here we're paying our owners. The next part of this entry, the next part says, well, I also want to give out an additional 10 shares to my common stockholders because my preferreds have already been paid. I want to give out an additional 10 shares, but instead of giving out additional cash because I'm getting kind of low, I'm going to issue 10 shares of common stock as a dividend. And my common stock has went up in value and it's currently selling for $15 each. So when I'm doing this journal entry, I'm still going to debit my dividend. And look, it happens to come out to be the same amount. It didn't have to be. My dividend value is I'm giving out 10 shares valued at $15 each. So 15 times 10 is my second dividend. It happened to be the same here. It's not going to usually be the same. And then I just got to state where this dividend come from. Well, it didn't come from cash or that I'm going to pay cash in the near future. It actually came from the issuance of common stock. So just like what I did back up in the problem number 1, when I got cash because of issuing common stock, I'm going to do the same thing here. I'm going to credit my common stock at its par value. 10 shares times the $1 par. And then I'm going to credit the common stock additional paid in capital for whatever's left. The final piece, on December 31, I want us to close out net income of $400 and then also close out the dividend account. Now I'm going to do this the quick and dirty way. If you want to do it the longer method to actually visualize what's going on, you should do that. But when I close out a net income of $400, I'm going to, in my head, come up with two numbers, revenue and expenses, that when I net them come out to be $400. And so I did that using $2,000 and $1,600 in expenses. $2,000 in revenues, $1,600 in expenses. So as we normally do, these revenue generally has a credit balance. So to close it, I'm going to debit my revenue. Expenses usually have a debit balance. So to close all my expenses, I'm going to credit them. And when I combine this, I would get the $400 of net income. And then when I close it, well, the remaining piece there is what goes to my retained earnings. Essentially, it's my net income. My net income goes into my retained earnings account. All of these I would be keeping track on off to the side in a T account sheet, because after a while it gets a little complicated to figure out what my balances are. The last thing I need to do is close out my dividends. But before I do that, I need to count up my dividends. I had 2 dividends, because you can't see my T accounts, valued at $300. So I'm going to close out my dividends account. My dividends are currently a debit balance of $300. So I'm going to credit my dividends and debit my retained earnings. Now we're ready for the last piece, and that's actually putting everything into the balance sheet, into the statement of stock, into the stockholders equity section. So let's do that at this point, kind of look at how that is laid out. Now you should have T accounts for all of these set up. The first thing that you'll see when I do this statement of stock, stockholders equity, this is actually part of the balance sheet. I just put here that this is the stockholders equity section here. That's how I named it. But if you look back to your T accounts, you should have only had 1 entry in the preferred stock. And then you had 3 different entries in the common stock. You had the very first 2 transactions were both common. And then kind of our last transaction when we gave out a stock dividend, or a stock dividend. So we had a $20 very first entry, a 10 in the second entry, and then another 10 with that stock dividend. That's where I got the 40 bucks. Both of these type of stocks are kind of, think of it like current assets. This is your heading. So we have these type of items in our capital stock heading. So like how we would total current assets, we're going to total our capital stock at this point. The next heading, like our long-term assets, would be additional paid-in capital. And then we're going to look at each one of those T accounts. You wouldn't have had to list your treasury here, but I put it here just so we know where it goes. Should I have some additional paid-in capital for treasury? Remember, we did have an additional paid-in capital treasury at one point, but we ended up getting rid of that because we sold some of our stock at such a low price. It wiped out any of our so-called gain. But the other 2 T accounts are still there, and we have a total additional paid-in capital when you add up those 2 of $660. Now, the book, I believe, has you can go ahead and total up these 2 items. It's not a necessity that you do, but I went ahead and put it in here. Next thing we'll come to is, well, our retained earnings. Remember that really important count. We had a few items going into retained earnings. We had our initial net income. That was a $400 benefit. And then we subtracted out our dividends. So that was a $300. So that took us down to $100 of retained earnings. And then if you remember, we had that one transaction when we resold our treasury stock, and we had a nice little debit there of $6 to retained earnings. So that brought us down even further, down to $94. Again, at this point, you could go ahead and do a new total. The only T account that we have left, because we've closed out our dividends, you don't want any dividends on your balance sheet, remember. The only account left is we have treasury stock. We still have 1 share of our treasury stock at $15 total. That is what it cost us to purchase it. So at that point now, I can go ahead and figure out my total stockholders' equity, part of the balance sheet. And I'm at $12.79. The last thing I want to do is go ahead and calculate my earnings per share. So remember, earnings per share, best case scenario. You take your net income, if they gave out every single dollar to our stockholders, subtract out how much has to go to my preferred stockholders, because I'm never going to get that, and then divide by our number of outstanding shares. Note I have 39. If you go back and recalculate, you might have said, hey, it's actually 40 shares because, well, we had the first two items that were 20 shares and then 10 shares, and then the dividend of 10 shares. So that was 40 shares. But the only thing left is, remember, it's outstanding shares. We still have one share that's kept back that we haven't resold yet. So that knocks us back down to 39 shares outstanding. So take this 350 and divide it by 39, and you're going to get $8.97, best case scenario, per common stock share. Actual dividends per share, well, if we go back and add up the amount of dividends my common stockholders received, if we go back and add up the $100 from the cash and then all of the common stock shares of dividends, so that was $150 worth. 100 plus the 150 is where I got the 250, divided by the same 39 shares. Common stockholders actually did pretty well, $6.41 each. And how you know they did well is you can compare it then to what did your preferred stockholders get. Remember, preferred stockholders were guaranteed $5 a share. And these guys ended up getting more than that at $6.41. Okay, that ends our session here on stocks. Our last and final session the following week, or coming up next week, will be on the statement of cash flows.